So we're just trying this again. I'm going to try to get a YouTube link up because
Okay, I have to go to the bathroom.
Okay, you have to say that on my live stream? The stream is going on right now.
No, it's not.
It is.
You're not live.
I'm live on my phone.
No, I'm on Lucas the Mortgage Man, and there's nothing.
You have to say that on my live stream? Anyways, hello, Evan C62. Welcome. We're just going to give people some time to join in. I'm just trying to get this live stream going. Wait for a few people to come in here, and then we'll talk mortgages. Just trying to figure out how to get the link to the YouTube live. People can maybe join us through YouTube. But, we will get there when we get there, I suppose. Okay, here we go. How's it going? Hello, Olivia. Welcome to the live stream. We're just waiting for some more people to come in. Once we get a few people in here, we're going to start talking about some of the most frequently asked mortgage questions. I'm going to go over the answers to those, and you'll learn a lot. Even if not planning on buying a house anytime soon, it's definitely good stuff to know for when you are. Okay. Hi, Mateen. Welcome to my live stream. I am trying to get a YouTube link for anyone who might not have Instagram. And once more people join, we're going to start talking about some mortgages. Or that's a lie. We're going to talk about the top 20 most asked mortgage questions. Hello, Brian. Welcome. Welcome to my live stream. We're going to start very soon. Very, very soon. In just a minute. Oh, sorry. I'm really hoping this works. I don't even know how to add a link to an Instagram story, but I guess that worked. Okay. So I suppose we'll get started now. There's a pretty heavy delay on the live stream. So I hope, I apologize if you do ask any questions. If it is, if I answer them kind of late, that's the reason why. It's because I obviously there's a delay going on, so I can't answer them right away. But alrighty, I suppose we will get started. Yeah, okay. So we're going to start off by going over the top 20 most asked mortgage questions. This is just stuff that has been asked to mortgage agents for a while, and it's been compiled by my brokerage, and I'm going to go through the list. I'm going to explain the answers to you as best as I can, and afterwards If you have any questions, you can feel free to ask and I'll answer them to the best of my ability. And yeah, so here we go. Let's get started. So probably the number one question that's asked across the board is, what is your best rate? That's what everyone wants to know, is what is your best interest rate on the mortgage? And here's the truth. So if you want the answer is right now on a 5-year fixed mortgage, I have access to 1.3%, which is an incredibly low rate. It is historically low, actually. But the truth is, I'm not sure that you have access to that rate, meaning that the rates are dependent on several things. It could be your Beacon score, your income to debt ratios, your LTV, which is loan to value, and whether your mortgage is insured or conventional. I know these terms may seem a little foreign, but once we start working together, you'll have sort of a better idea of what all of this means. And truth is, I won't know any of this information until I pull your credit and put your application together. So, if you are looking and you want to know what rate you qualify for, let me know and we can work on a consultation together. Alrighty. Next question. Moving on. What if I don't have great credit or a high Beacon score? So essentially, we have lenders for all types of deals. There's a mortgage for everybody. You may have to pay a bit of a higher rate using a different type of lender, but rest assured, I'm sure we can find you a home. But again, I won't really know based on your situation until I put your application together and pull your credit bureau. So it's really going to be dependent on, in your specific situation, you'll have to get in touch with me and we will work on something together and I can get you the real detailed answers to these questions based on your own current situation. Next. So I am business for self, or I'm self-employed. I don't show a lot of income on my taxes, but I make a lot of money. Will I still qualify? We have access to a number of stated income products, and every lender uses different qualifying matrices outside of supplying your notice of assessment. We even have lenders that require no notice of assessment or no proof of income. We have lenders for everyone, really. Alternative lenders offer lower barrier of income confirmation. However, you'll still need to provide some proof of cash flow by way of 6 months of bank account statements, financial statements. Point is, you have options. Even if you don't have an NOA or stuff like that, you have options. And again, it's my job to provide you with those options. Next, what is the stress test? This is a very important one. The stress test is essentially, it was introduced by the government of Canada to ensure that Canadians are able to absorb any increase in mortgage rates when your mortgage comes up for renewal, in the event that rates increase. So how does this work? So when you apply for a mortgage, you will have to qualify on the higher of two options. Either the rate on your contract plus a 2% cushion. So for example, if I qualify you at right now 1.3% plus 2%, that gives us 3.3%. You'll have to qualify either at 3%, 3.3%. That's not true because the second option is the benchmark rate, which is now 5.25% as of June 1st. That just increased. So the truth is I will have to qualify you at the 5.25% because it is whichever of the two options are higher. So in this circumstance, 3.3 compared to 5.25, I'll have to go with the 5.25. But let's say I qualify you at, 3%, just to make the numbers easy. 3%, we add 2 to that, that's 5. Well, it's still 5.25. That was a bad example. Let's say I qualify you at 4% plus 2, it gives us 6%. As compared to 5.25, I qualify you at the 6%. And that's sort of how the stress test works in as simple terms as I can explain it. Next, I already have house insurance on my property. Why do I need mortgage loan insurance? I know, so mortgage and housing often get tangled up into the same world, but these two types of insurance are completely different things. So your home insurance protects you in case of fire, severe weather conditions, accidents, or anything that causes damage to your home. So your home insurance protects the home, the physical walls, your house, your physical house. Mortgage loan insurance is for the lender, and essentially it protects the lender in the event that your mortgage defaults, meaning you can't make a payment. It protects the lender. It makes sure the lender is not losing that money. That's what mortgage loan insurance is for, and it is, yeah, that's what it is. Next question: should I take a variable rate or a fixed rate? And we can get into what that means later on. If you know, great. If not, I will explain it later on. We'll go through a sort of glossary of terms as well. So should I take a variable or fixed rate? A fixed rate means that you're locked in for a term and know what your monthly mortgage payment is, and it will not change until the end of that term. So the term being like 5 years, for example. That rate will not change within those 5 years. A variable rate are often lower than fixed rates. However, they do fluctuate with changes to the Bank of Canada rate, meaning that if you start off at 1.3, your number could increase or decrease within your 5-year term. But at the end of the day, again, this is determined on a case-to-case basis based on your income situation. If you can afford, fluctuations in your rate, an increase in your rate, then of course go with a variable for sure, no doubt. But if you kind of are making an income that is sort of iffy and you need to really ensure that your rate doesn't change, you go for a fixed. Moving on. I apologize if you hear any noise here. I'm just in my basement office here. I got all the friggin' water pipes behind me. Next question. Should I take a 25-year amortization or shorter to pay down my mortgage faster? So this is going to have a lot of logistics here, and I'm going to do my best to explain it simply. So in most cases, you should always take a 25-year amortization, even if you plan on paying down your mortgage. And here's why. So in most cases, you will have prepayment options. So even if, even if you're halfway through your amortization, halfway through your term, and you come across a whole bunch of money and you're like, I want to pay this mortgage off, you'll have the option to do that. Here's the difference. So if there's ever a change in your financial situation for the worse, knock on wood, you can always go back to your regular payments. So if you start off at 25 years, you have a 25-year amortization. In that period, if you want to speed that up, you can, and then you can go back. However, if you're in contract at a lower amortization, shorter amortization, we can't increase the amortization to make your payments, your regular payments, smaller. So you remove that safety net by putting a shorter amortization period on your contract. If that makes sense. If you have questions, feel free to ask on that one. I know it's maybe a little more complicated, but I hope I did a good enough job in explaining it. And if the case is that you do want to prepay, if you know you want to prepay, when you're working with a mortgage specialist, whether it be myself or anyone else, you should let them know that you plan on prepaying it, and we will make sure to place you with a lender that has prepayment options. Because not all of them offer that, but I'm pretty sure most of them do. Next, how much money do I have to put down? This is a very important question, because when you're looking at a mortgage, you'll have to know, obviously, whether you have enough of a down payment to even qualify for one. So the minimum down payment when purchasing a property is 5%. However, the property must be owner occupied, and you will be required to pay mortgage insurance, which we went over previously, what mortgage insurance is and why you need it. And then on top of that, sorry, my apologies. If you don't want to pay mortgage insurance, you'll need to put 20% down. And that's 20% of the mortgage, if I'm not mistaken. 20% of the mortgage. And so some lenders require a larger down payment for business, for self-applicants, or for rental properties. Something that should be known is that not all lenders are the same. So when I say lenders, I can explain what I mean by lenders. When I say lenders, I'm talking either banks or mortgage finance companies, I believe they're called, which is not the big five. Big five being TD, Scotia, RBC, CIBC, and BMO, I believe, if I'm not mistaken. And so all these lenders are different, essentially, and they will offer different things. Some will offer more things, some will offer less things. but they're all different. And so that's why these questions are very generalized, but everything will depend on a case-to-case basis when you go and talk to your mortgage specialist. Moving on. So what are closing costs? Closing costs include the lawyer's fees, water taxes, the land transfer tax, disbursements, and adjustments of previously paid bills such as water, hydro, property taxes, and land transfer tax, which is what I just said. A minimum of 1.5% of the purchase price over and above your down payment must be readily available, and some lenders may require proof of these available funds upon approval. Now, keep in mind the GTA and GVA are double the land transfer taxes, so 1.5% may not be enough. Always confirm the amount required with your solicitor, that being your lawyer. What is bridge financing? That's the next question. What is bridge financing, and do I need it? Or do you need it? Bridge financing is when the property you bought is closing before the property you sold, and you need to pay for the new property in full on closing. So, of course, usually when you sell a house, sell your house, you get that money from the house you sold, use it to buy the house you bought. However, in some cases, this isn't the case. The house you're buying is closing before you sell your own house. You don't always have the money to pay for the new one. And that's bridge financing. So not all lenders will offer bridge financing. So if you do require a bridge, it is my job to ensure that I go to a lender that does for all of your financing needs. Bridge financing fees can range anywhere from $250 to $500, and most lenders charge prime plus 2%. Lenders will also look to register a lien on both the purchased property and the property you're selling. For those of you who don't know what a lien is essentially a form of security, similar to like collateral, right? So the lender will essentially put a lien on the property you bought and the property you're selling, saying basically if you can't hold up your end of the deal, they can seize those assets. But if you do, what's the word? If you do live up to sort of your end of the bargain, that lien is dropped and everything goes on as planned. How much money can I take out of my property? You cannot exceed 80% of the value of your home. And remember, if you qualified originally for your mortgage under the old rules, you would now be subject to the stress test when applying for a refinance. If you have accumulated debt, a refinance will help to get rid of high interest payments and, and in most cases, increase cash flow. With low rates, a refinance can be used for other investments, which would provide a higher return than the interest you're paying on your mortgage. Did I turn this back on? Yeah, I did. Okay. Yes, so a refinance, like right now, the rates are super low. So if you are looking to refinance your mortgage, now would be a pretty good time to do it before those rates start increasing, so that's what they're predicting. So again, you can shoot me a DM on Instagram. I even have my email in my bio, so you can send me an email as well. Or if you have my number, feel free to call me. Any way you can contact me, feel free to do so, because I am here to help. Next question. What's the difference between MFCs, which I mentioned before, mortgage finance companies, which were previously known as monolines, and a bank? So mortgage finance companies have only one line of business, which is mortgages. So they don't deal with savings accounts or credit cards or anything like that. It is strictly mortgages. And they generally offer more competitive rates, great mortgage products, and better service levels. So if you're ever talking to the bank and you get like super frustrated and you're like, these people are screwing me over all the time, well, yeah, that's because it's a bank. And I'll go into I can talk about my opinion on banks later, but I did promise unbiased information. So maybe I won't do that. But anyways, yeah, so they typically offer, like I said, competitive rates, great mortgage products, better service levels. Mortgage finance companies don't have posted rates the way that the banks do. So when it does come to penalty calculations on a fixed rate product, which we went over before, you can save yourself thousands of dollars if you do have to break your term. And I mean, some of these mortgage finance companies, they have over $100 billion in mortgages under administration. They've been in business for over 25 years. They're publicly traded, and in most cases, actually underwrite and administer mortgages for our banks. So if you're thinking like these guys are shady, they're going to send me to loan sharks, they're going to say that, these are reputable companies that have been around for a very long time, and you can rest assured they are legitimate. This is, if anything, the biggest question that you're going to hear today, the biggest answer. Why should I work with a broker/agent? The answer is options. We work with banks, MSCs, credit unions, alternative lenders, B lenders, and even private lenders if need be. We say yes, essentially, when the banks say no. And in most cases, we will have a way to get your mortgage done no matter what. This is the best analogy I can give you. When you go to buy a car, let's say you go to a Honda dealership and you want to buy a car. Honda's priority is selling you a car off their lot. They're not going to tell you, a Toyota, you might be better off in a Toyota. They're never going to tell you that. They're going to say, this is the right car for you. Even if it really isn't, if it's on their lot, that's your car. Right? And the same thing goes for I'm just using Honda as an example, but I have nothing against Honda. That's just the first company that came to my head. We are the company, essentially, that you would go to find out which car is best for you. And then we would send you, or we would actually deal directly with that dealership to get you that car. That's the difference, right? So apply this into banks now. Let's see, if you walk into a Scotiabank, again, just an example, I have nothing against Scotiabank, but, just as an example, you walk into Scotiabank is trying to sell you a Scotiabank mortgage. They're not trying to sell you a CIBC mortgage, which means they're not really giving you options. You're just getting the Scotiabank options. But when you come to a mortgage specialist like myself, who works with a company like Dominion, who is one of, if not the biggest mortgage brokerages in Canada, we provide you with those options. So we will shop around for you. We'll look into Scotiabank, we'll look into CIBC, we'll look into the big five, all of the mortgage finance companies, alternative lenders, credit unions, B lenders, private lenders. We will do everything we can to get you the right mortgage for your unique situation. Because the truth is, it doesn't matter improper choice of wording. It does matter to us which mortgage you get, because of course we want to help. But from a strictly financial standpoint, it doesn't make much of a difference where we place you, because we aren't the one giving you the mortgage, right? So we are outsourcing the mortgage for you. So you're not getting a mortgage directly from Dominion Lending. We're not the ones directly giving you the money. So whether we put you with Scotiabank or CIBC or TD, that comes at no loss to us, right? And of course, that's speaking strictly from a financial situation. I can't speak for every single mortgage specialist out there, but I believe that the priority is helping people first, money later. And so obviously that's why I went with a brokerage and not with a bank, because it just doesn't sit right with me that I would try to sell someone something that is not in their best interest. So if that doesn't answer the question, I don't know what will. So next question. I have claimed bankruptcy in the past. Will that affect me now? So here's the truth. If the client has been discharged from bankruptcy for 2 years with 2 credit trade lines for 2 years, and there was no property included in the previous bankruptcy, then I can send your deal to a bank. If a property was involved in the bankruptcy, or there's been missed or sloppy repayment after the bankruptcy, essentially if you've proven that nothing has changed after your bankruptcy, then most A lenders will not entertain that deal. So it's, again, if you are in that situation, let me know and I can get you even more detailed information on that. But as of right now, that's all I have. But if you really want to know more, you can even let me know in the chat right now. I can get more information for this and I can bring it up in my next live stream that I do. Moving on. So we already talked a little bit about what mortgage loan insurance is, but I'm going to go a little deeper into that. So mortgage loan insurance is required if your payment is less than 20%. Like I said before, if you put less than 20% down payment on your mortgage, you will need mortgage loan insurance. This insurance protects your lender in the event that you default on your mortgage payments. And the current mortgage loan insurance companies are CMHC, Genworth, and Canada Guarantee. And yeah, that's basically that. We already talked about how it's different from house insurance, but I guess we go into more detail on that as well. All lenders require you to have a home insurance policy. So if you go to a mortgage company and there's no insurance on your home, unfortunately, you're not going to get a mortgage in 90% of cases. I'm sure there's probably a lender out there that doesn't, that isn't like that. I'd have to do a bit of searching, but I might be able to find something. I might not. Again, I don't know every single lender out there, but I do know most of the large lenders, the biggest ones out there, will require home insurance. And this home insurance protects you in case of fire, severe weather conditions, accidents, or anything that can cause damage to your home, as I said before. Home insurance policies offer full replacement or payouts in the case of damage, and that has nothing to do with mortgage insurance. Moving on. What is mortgage life/disability insurance, and is it optional? So the Mortgage Protection Plan, which is underwritten by the manufacturer's life insurance company, which is part of Manulife Financial. This insurance plan provides mortgage insurance that will pay off your mortgage in the event of death and offers total disability protection as well. As a mortgage broker, or mortgage agent, my apologies, it is my responsibility to ensure that you are offered mortgage life/disability insurance on your mortgage. Your lender will also offer you a similar mortgage life/disability policy. Please be advised that there are differences in terms of these policies. Next, do I need title insurance? What is it, and why do I have to pay for it? Your lender could require title insurance. And for those who don't know what it is, title insurance is an insurance policy that protects residential or commercial property owners and their lenders against losses related to the property's title or ownership. Title insurance is not a requirement in Ontario. However, your lender could make this a condition of financing. If the lender doesn't, then the decision on whether or not you should purchase title insurance should be discussed with your lawyer, title insurance company, or insurance agent or broker, which is not me. To fully understand what type of protection title insurance can provide you, and to determine if other options exist, once you get all the facts, you can make an informed decision based on your specific situation and needs. It is essential to keep in mind that title insurance does not replace legal advice when purchasing a property. So you'll always want to get your own legal advice when you're doing that, because anything could happen when you're not a specialist in it. So what does title insurance cover? For a one-time fee called a premium, a title insurance policy may provide protection from unknown title defects, title issues that prevent you from having clear ownership of the property. So existing liens against the property's title, for example, if the previous owner had unpaid debts from utilities, mortgages, property taxes, condo charges, secured against the property, it'll protect you against that, from taking that on. Next, encroachment issues, for example, a structure on your property needs to be removed because it's on your neighbor's property, title fraud, errors in surveys and public records, and other title-related issues that can affect your ability to sell, mortgage, or lease your property in the future. And your title insurance policy will protect you as long as you own your property and will cover losses up to the maximum coverage set out in the policy. It may also cover most legal expenses related to restoring your property's title. Okay. So that's it for the 20 most frequently asked questions. If you have any questions of your own, feel free to drop them in the comment section, and I will do my best to answer those. Either right now, if I can't answer them right now, I will write them down and I will find an answer for you, and I promise you I will get back to you in a DM with an answer. I also wanted to talk a bit about the First Responder Mortgage Program, which came into effect on June 1st, except that my package that I was supposed to get, I did not get, and so I don't know all of the information about it. But essentially, it is a program that we are doing with Scotiabank right now that will offer first responders super competitive rates, cashback options. I do have a little bit of information on it over here. I just got to find it. Where is this? Mortgage. Sorry. First responder. This is coming right off the Dominion Lending website, by the way. So if you wanted to find this out for yourself, it's You can. It's all right here. So this program is being offered to police officers, paramedics, firefighters, whether they are employed firefighters or volunteer firefighters, correctional services, border services, search and rescue, again, whether it's employed or volunteer, registered physicians, and registered nurses. So if you are any of those, you are eligible for this program. And this is our promise, as per the website. The Dominion Lending Center's First Responder Mortgage Program aims to provide you and your family with the best available mortgage option, from purchasing a home to switching from your current mortgage lender. We are here for you. If you're eligible for this program, you have access to the following incredible benefits. So competitive rates, as I said, up to $1,600 cash back on all eligible new purchase transactions, or up to $1,200 when you switch your existing mortgage to a new qualified fixed or variable rate mortgage. You can also get up to $400 for discharge and switch fees, meaning getting discharged from your mortgage or switching to another company. And then we also have additional cash offers available with certain eligible banking packages. And that is essentially all of the information I have right now. I don't have much on rates or anything like that, but that is pretty much what I've got for you right now in terms of that. Hopefully I can do another live stream just about that package for our first responders, because I really do think it's time to give back to our first responders after this last year. They've just done so much for us and our society. I think it's great that I'll hopefully be able to give back as much as I can to them. And yeah, so that's about it for Let's Talk Mortgages, at least for this first stream. If there's anything else you would like to know about mortgages, please ask now, and I will do my best to answer for you. If not, if you want a mortgage, you are always welcome to message me on Instagram, send me an email, give me a call, and we can do a consultation for free. I won't charge you for a consultation. And we can talk further about what is best in your current situation. Otherwise, thank you all for coming. I appreciate your staying here and listening and learning. And yeah, I guess I will wait a bit if anyone has any questions, and then I will sign off. Also, I've been looking down because I have my phone here so I can monitor how I look on screen. Because the software I'm using is glitching out on my computer. I don't have any feed here. So I've been looking down at myself on my phone every so often instead of up to you guys in the camera here. But yeah, I'll try to get that fixed for the next one. I figured I would use my computer because I've got this microphone attached. So it would sound a little more clear. But yeah. Alrighty, if there's no questions, I hope you all had a very informative half hour, and I hope to see you guys soon. And yeah, the future is in your hands. So if you're ready to start making some money, if you have some debt you want consolidated or anything like that, you can let me know and we can work something out for you. Alrighty, guys, have a good one until I see you next time. Stay posted, and